Hey, it's Pat Jennings again from thebizseller.com, and this is video number 3 in my series of 5 short videos on the basics of small business valuation. And what I wanted to do this time was answer some of the more common questions that come up at this point. And a couple of the questions really have to do with definitions. And here's a common question that's been emailed to me. What is the difference between what you call owner's benefit and the acronym EBITDA? EBITDA means earnings before interest, taxes, depreciation, and amortization. And owner's benefit is what we covered in the last video, which is the basis of earnings that you should use in your multiple of earnings calculation. And the biggest difference is that EBITDA is used in larger businesses where the owner isn't the manager. And so in that acronym, EBITDA, the E obviously stands for earnings. That's the earnings of the company after they've paid the management their salary. The owner's benefit is the profits or earnings of the business plus the owner's salary, because the owner is the manager. So that's the big difference. If your business has a full-time professional manager that you pay, you would use EBITDA. But if you're the manager and the owner and you're selling it to someone who's going to also manage it, then the owner's benefit is the more accurate, more truthful description of the earnings, because that salary for the owner is a benefit to the owner in smaller businesses. So that's really the only difference between, the biggest difference between EBITDA and owner's benefit. Use owner's benefit if you own the business and you're the full-time manager of the business. The next question is along those same lines. What's the difference between owner's benefit and seller's discretionary cash flow or seller's discretionary income? Nothing. Seller's discretionary cash flow sounds like an accounting term. Well, it is an accountant's term. I use owner's benefit because it's more descriptive. It's the benefits that the owner gets, the financial benefits that the owner gets from owning the business. And just when you're dealing with buyers, anytime you can get rid of jargon, and seller's discretionary cash flow sounds like jargon to me. Whereas owner's benefit, it's the benefits that the owner gets, and buyers want to be owners. So I just think just from a sales perspective, when you're dealing with the buyer, it's better to refer to your earnings, your profits, as the owner's benefit instead of the seller's discretionary cash flow. So the difference between owner's benefit and seller's discretionary cash flow is they're the same. They're describing the exact same thing. And now here's a really common question, and I've talked before about rules of thumb. Different industries have rules of thumb. A restaurant should sell for 70% of its sales, or a retail should sell for X percent of its sales plus inventory, what have you. Every industry, grocery stores have one set of rules of thumb. Laundromats have another one. And the question is, where do these rules of thumb come from? Most of them come from surveys done by trade associations that serve a particular industry, and a lot of them come from surveys that are done of business brokers. An association of business brokers will survey its members to see what businesses are selling for. If you use a rule of thumb, remember that the rule of thumb, assuming it's accurate, and like I said, a lot of industries have 3, 4, 5 different rules of thumb that lead to different outcomes, so how accurate can they be? But if you use a rule of thumb as your asking price, you're going to be hurting yourself, because these rules of thumb are based on selling prices, not asking prices. When you value your business, you're trying to come up with a price range or an asking price range, not a selling price range. You have to be prepared for the fact that you're going to have to do some price negotiations when you actually sit down with the buyer. These same industry surveys that come up with the rules of thumb typically report that small businesses eventually sell for about 75 to 80% of the original asking price. And the eventual selling price is what's used to calculate these rules of thumb. So you don't want to use a rule of thumb as your asking price because you'll be setting your asking price too low. If you use a rule of thumb, add 25% to that, realizing you're probably going to have to come down 20% or so. So those are three of the most common questions I get, and so I wanted to take this edition of my series here to cover those most common questions. Now, if this is the first video you're seeing of me, I'd like to invite you to go to thebizseller.com and sign up for my free weekly Sell Your Business Tips newsletter. That's thebizseller.com. When you get there, you'll see a sign-up box at the top of the page. Just enter your first name, your email address, and the current issue of my Sell Your Business Tips newsletter will be on its way to your mailbox. And then going forward, every single week, you'll get a new issue. And in this newsletter, I cover all aspects of selling your business, not just valuation. So if you found any of this helpful and you want to get more help and insight and information and advice, go to thebizseller.com and sign up for my free weekly newsletter. Thanks.